out there. All right, let's jump in, boys. All right, welcome to Money Talks. We're here to talk about all things money and finance. I'm your host, Will Esposito, joined by my two co-hosts and longtime good friends from East Stroudsburg University, Michael Petrillo and Chris Badaracco. Welcome, fellas.
What's up, Will?
What's going on? I believe we have a disclaimer we need to read. Yes, we do.
Throwing the Rose Wealth Advisor won't tell you.
Yeah. This episode of Money Talks is actually brought to you by Rose Wealth Advisors.
Oh, wow.
I don't know if you guys heard.
They're an up-and-coming financial firm located in Jersey City, New Jersey, handling investments, tax, estate planning, insurance.
Handled with care.
If interested.
Handled with care.
Handled with care.
They manage the money for you, so you have more time to manage your life.
Did you just make that up?
Right on the fly.
He stole that from Prudential.
Is that Prudential? I wouldn't be surprised.
I have no idea.
But just to come back to that, I'll go ahead and read off this disclaimer for our viewers, because unlike Rose Wealth Advisors, we also need to let you know that the views and opinions expressed in the show do not reflect the views and opinions of Pzna Investment Management. We good with that one?
Yes, that was perfect.
All right, guys, cool. So a lot of young people have reached out and mentioned that they are interested in the stock market. They're interested in investing, and they want to know the basics, but also from some people who actually are in the field, who know firsthand, who have that industry experience like you guys. I definitely want to dive right in so our audience can get as much value and information from true professionals, from true people in the industry. So that's why we're here today. Mike, I want to ask you, because you have direct experience right now. So you do too, Chris, as well. It's not like
he's not picking favorites. He's not picking favorites.
Mike's job is way more interesting as far as stock picking than mine. I'm more ETFs and mutual funds, right? He's seeing the big money movements.
Awesome. So yeah, Mike, tell us about that. Let's start at a very low level or basic level in terms of like, what are stocks? What are ETFs? What is the stock market?
So think of all the companies that, you use products for, right? Apple, Amazon, Google, Facebook, anything you see, Exxon, right? Those are all companies that sell a product or a service. And basically a stock is a certificate of ownership of a piece of that company. It may be a very small fraction of the company, but at the end of the day, you are still a shareholder of that company, and some other things come along with that. And there are reasons why companies go public. One of the most important reasons is when a company is starting out, if they want to grow, they need funding. So a way that they are able to fund their future growth is by issuing shares of their company to the public. And I kind of look at it as a win-win situation, right? Someone like myself or you or Chris, we don't have the capital. We don't have the money sitting under the mattress to just buy Apple, right? Like the company itself. Like there's no way that we would be able to just walk up one day and just say, I want to buy the company Exxon. I just want to own the whole thing. That's just impossible. So this is a way for the company to grow and also for our wallets and our bank accounts to grow as well. But like we've alluded to in previous episodes, stocks are just, they're not, they're not always going to go up. Right now, it might feel like they're going up all the time, but you can't just buy a stock because you heard someone say that they're buying it. You can't just buy a stock because, you've been reading about it, or you saw it on a like headline, right? If you're going to buy a stock opposed to an ETF or mutual fund, you should really do your research and due diligence, and actually know what the company sells, actually know what the company's vision is, and see if it actually, like, you align yourself with what they do, right? If you are someone who, thinks cigarettes are disgusting and thinks that, tobacco is awful, you probably shouldn't buy Philip Morris, right? You shouldn't buy an ETF or a mutual fund that has large holdings in tobacco products, right? Because it doesn't make sense. You should align yourself with that vision.
And I think that's becoming more and more of the norm. And I won't jump away from stocks for a minute, but ESG investing, which is environment, social, and governance investing, tends to be really up and coming, where people can align their values with their investments and weed out certain investments and see what is, as far as an ETF or mutual fund, what's their screening process as far as their underlying securities and holdings, and does it make sense to invest? If I don't want to invest in a company that invests in companies in firearms, or in in gambling, or in tobacco, then there's exclusionary screenings that these companies do that look through their underlying holdings, and that's pretty much just as important to them as it is that this is an ESG that invests in large cap companies. So just as important as them that their focus is slowly, large cap growth companies, it's almost just as important where they're only investing in companies and excluding certain values. But I'll let Mike kind of continue on the stocks. And
yeah, so that's definitely, I'm seeing a lot of that in the industry. ESG is definitely big. But back to we kind of went on a little bit off the rails there, but the basic concept of a stock is it is a share of the company. So even if the company has issued 1 billion shares, or whatever the number is, right, or whatever that number is, if you own 5 shares, you actually own 5 shares of that company. And I remember when I first started getting into investing, I started off owning like a share of something. You have to start small. And even if I only owned 1 share, and there was some kind of event coming up where the executive board, or they wanted their shareholders to vote on something, I know 1 vote is not going to mean much with all those shares of the company out there, but I got a vote. You get a vote as a shareholder. So it's
interesting. You might get like a letter, like a proxy vote, because you are actually a shareholder, and get that in the mail, and as if you're part of the company. And there could be a lawsuit where the company might be entitled to some money, and if you're a part owner of that company, if you fill it out and send it back in, you could be entitled to the same kind of benefits, or benefits as if you were owner of that company. So I think it's interesting as far as actually owning a piece of a company through
yeah. And that might only be, if you only have a couple of shares, you might only get $1, right? Like, when these lawsuits happen. But yeah, to Chris's point, that actually got me more into it, right? Like when I actually got, and not that some of them I didn't even care. I looked at it and I was like, I don't really, I voted yay or nay, whatever it was. Like, it wasn't a big deal to me, but it was nice to see that it was real. Like, I actually did own you do actually own shares of the company. And again, it got me kind of into it too. And like, they roll out a new product or they roll out a new service. If you align yourself with a company that you actually like, it is pretty awesome to see the company grow and
I
see it
agree.
progress.
I agree. And I think that's how everybody starts, is buying individual stocks, because I think had a hunch over something, or like when Facebook came out, I had a hunch, and I was so excited. Like I was like, all right, I love this product. I think
Should have
everything
held.
is huge.
You should have held.
I sold it for like a $5 gain. And I was like, ooh, great, great, good stuff. Now
I can go out tonight. Yeah, I can
yeah,
go
now I
out
can go
tonight.
buy dinner tonight in East Stroudsburg. And now look at it. It would have, if I held that same position, it would have been up. I don't even know where it's at now. It's probably at like 200, $300 a share. But even so, like I think I bought it for like $20. But there's also times where I've been burned, and I realize that this is not, it's not necessarily owning one share of a company isn't necessarily a diversified portfolio. And like I'll give you this example. I think it was just out of college, and there was this company, I don't even remember the name of it, but the symbol was GTAT, and they created the covers of the iPhones, and they were supposed to make the glass protection on the phone. And I was really into it. I was reading up on it, and like the iPhone 5 was going to use all these different things, and I was so excited about it. Of course, last second, Apple decides to go a different way with it, and that company just completely goes bankrupt. And it was like, not that I had even that much money to invest in a single company, but I invested in a single small cap company that had all this promise about their contract with Apple that would make them very, very profitable. And it just didn't happen. And I fell flat on my face. So it was a learning experience. And I think, unfortunately, I think that's the best way to learn, is kind of getting burned and kind of putting yourself out there and doing it. But I would try to learn from other people's mistakes and take it and listen to Mike and listen to other people in the industry as far as investing, and kind of get your bearings right before you kind of, you start. Unfortunately, that's part of the game. You will end up getting, as you do kind of learn investing, and you're kind of, you're making dumb mistakes as you go. It's You're gonna have winners, you're gonna have losers. That's the name of the game.
Yeah, and I think just as you're getting familiar with it, like I said earlier, just buy stuff that you actually like. Like that's kind of just what I live by. Like I don't own shares of companies that I don't use. I don't own shares of companies that I don't like. And it doesn't bother me personally if the stock goes up. Like if there's a company that I don't like and they're up 50% over the year, I don't have that feeling of I missed out, because I don't actually like the company. So that's just how I feel. Maybe other people will always have that FOMO where like they're like, oh, I should have invested, but I don't. I have that feeling if I like really love a company and I don't buy the shares and like chicken out, and then it goes up, then I have that crappy feeling, because like you almost like second guess yourself. But yeah, just if you're going to go to stocks, and if you're not going to go the route of, I mean, look, you can do both, right? You can have single name stocks and ETFs and mutual funds. There's no stopping you from doing all of those things. But if you're going to do single name stocks, just please, just actually do the research and actually like look into what you're buying.
Because there are people who are been doing it for 40 years and have the experience and do it, and even they get burned buying individual
Everyone gets
securities.
burned, man. You're gonna get burned.
So you need to really be careful. And that's why I like ETFs and mutual funds. I put my clients in ETFs and mutual funds, just because I think having a more diversified portfolio, and the ETF space is, you buy an ETF, it's going to track the index. You buy an iShares S&P 500, it's going to move in line with the S&P 500, and that's going to track that benchmark, because it's going to hold a high volume of shares, and realistically it's going to move in tandem with that benchmark. Mutual funds, on the other hand, have an active manager, and depending on the sector that you kind of pick, that's what they're gonna know, and they're gonna do, and they're gonna specialize in, and they're gonna actively try to beat that sector. If you buy an emerging markets mutual fund, that manager is going to actively try to beat the benchmark of any kind of emerging market country such as China, Taiwan, India, Brazil, and they're going to know that industry and actively try to beat that benchmark. So I think it makes sense to have mutual funds in sectors that tend to be more volatile, because you're having actual experienced investment managers looking at it and trying to beat the benchmark. And yes, it becomes more expensive for that reason. But an ETF is pretty much the safe bet that you're not a safe bet. It's not, nothing's a safe bet, but it's a safe idea that you hold a massive amount of securities that are also going to be, they're held in the benchmark that tracks that sector, and it will also move in tandem with that sector. So they for that reason, they tend to be less expensive, and mutual funds tend to be a little bit more expensive. I'd also, one thing I'd also say is also kind of do you even as far as doing research in stocks and individual securities, do your research on mutual funds, because there are some that hold 300 positions and are less conservative. There's also some that hold 20 positions and are very concentrated, and honestly are almost, you could argue, are just as aggressive as a stock with a large market cap. So I mean, take a look at the underlying positions and how it's been performing, and make sure you do your research there as well.
Want to back up a second, because I know you just went pretty deep into ETFs, but if we can just back up and kind of explain what that is exactly. What exactly is ETF? What does it stand for? Just kind of break down a little bit.
An ETF is an exchange traded fund. So, and Chris, you can correct me if I'm wrong or step in at any point. But the main differences between an ETF and a mutual fund, like you alluded to earlier, is that they're mutual funds of an active manager, where ETFs do not.
Majority.
There are some, right?
There are some, and there'll be a slightly higher expense ratio, but for the most part, like if you went with a Vanguard, an iShares, that's kind of like their bread and butter, is a low cost expense ratio that is going to just move in tandem with whatever sector you choose in that ETF. It could be international, it could be large cap growth, large cap value, and S&P 500 ETF. It's going to move in tandem with that sector.
And ETFs they're more transparent, correct?
As far as what's underlying,
yeah.
I mean, you can pretty much see it's not really going to be. They're not really going to be making too many swaps. It's going to be more of a swap if a fund comes on to the gets pushed up to the S&P 500. That now will be that ETF will now hold that security, and most likely hold that security or enough securities in that 500 to kind of follow it pretty much in tandem.
Okay, so yeah.
So I was going to say, did we touch on the fact that, so also I like to explain it as in like the underlying securities of the ETF or the mutual fund. I like to explain it as like getting exposure to those names. So you can explain it as owning little pieces of it, but basically these ETFs and mutual funds, they have different weightings. And so the actual ETF or mutual fund does hold the securities, right? They hold the securities in their basket of securities. So
the other thing about that, which is nice, is that you can literally go on Morningstar, you can go on Yahoo Finance, and you can look at that mutual fund, and they need to report what their holdings were. I mean, Mike, better than me with it's like what, 45 days after the end of the quarter, they need to report what was the holding of that mutual fund for that past quarter, and what were the percentages of, what percentage they have in Uber, what percentage they have in Microsoft, and you can literally see how that mutual fund's been invested. And they have to tell you the amount of funds that they held, and you can kind of go in there and kind of do your research. If you wanted exposure to like an Apple or Microsoft, there's ETFs that focus literally on technology.
Right.
And I guarantee you can find one that's going to be about 20 to 30% split between the two of those funds. And then the rest will just be, a handful of all the other technologies, ETFs,
Right. So
stocks.
To Chris's point, so let's say you're interested in a few of those big tech names, Google, Apple, Amazon, Facebook. You can specifically just Google search it, man. Just look into ETFs that have a heavy weighting in those names. And so if you, let's say, for argument's sake, right, you find an ETF that's $100 a share, right? You can see if their top 3 or 4 holdings, for, again, this is not the way it's going to work out, but for argument's sake, Apple, Amazon, Google, Facebook, each, they have a weighting of 10% of each of those companies. You know that 40% of the ETF that you're buying, you're getting the 40% of that exposure is to those 4 names you really like.
Right.
So it's a good way to get exposure to those names. If the price is a little too steep for you, if the risk is a little too steep for you, I think it's a great way to get exposure and not feel like you're too exposed to the one name.
Right. And that's my feeling on individual securities. I just think I think when you look at it from when I tell my clients, and it's like you're investing in individual security, it's kind of like looking at your balance sheet and making sure that is that portion, you don't want like there's people who get stock options and they have, they may have like a good portion of Facebook stock and they might fall in love with it because they're working for the company and they are drinking the Kool-Aid and they think Facebook's going to be the greatest thing ever. So they end up having closer to like 30 to 40% of their balance sheet in Facebook. And they're also working to Facebook. So their income is tied to Facebook.
It's like doubly.
However,
it's like the exposure is like, it's like
if
Zuckerberg, threefold.
Zuckerberg comes out tomorrow and all of a sudden he says he's stealing everybody's information. And it's like, all right, great. Now I have 40% of my money tied up to this company that is literally going to just, might be getting sued and
like Lehman, like Lehman Brothers.
What's that?
Like Lehman Brothers back in 08.
Now you're in quarter to 50% of your balance sheet might just disappear overnight because you're so concentrated in this one stock. Whereas an ETF, you could have a heavy portion into
Chris is scaring the kids into ETFs.
He's
just scaring them
from personal
scare tactics.
I honestly, so funny story. My first job, I did accounting at a wine distributor, and there was a guy on staff. He was a CFA, like end of his career. I honestly think he was way overqualified, and like he just did it for fun. And I would always go into his office and just like pick his brain and ask him about stocks because I didn't know better at the time. I just graduated college. I think he's probably, knows all this stuff where he's day trading. And he's like, so what do you own? What stocks do you got? And he's like, I own one stock. He's like, I own Apple. That's it. And I was like, oh, he's like, yeah, I just own mutual funds and ETFs. Like, so you want to buy individual stocks? Like, go bet on the Jets. I was like, oh, all right. You
probably have a little. Bet against the Jets.
Bet against the Jets.
Bet against the
better
Jets.
Odds,
bet on the Jets.
But like, I guess that was my thought process. I was like, okay, like, yeah, it's very risky to own one security. Granted, if you have a stock that has, an enormous market cap on the S&P 500 or on the NASDAQ or whatever benchmark it's on, it's probably going to move in tandem with those stocks. However, being, out of college, not knowing better, I've obviously was buying the GTATs that are going to make me, get rich quick schemes.
That company haunts
and
you.
Then getting smacked in the mouth with it when Amazon comes out of nowhere. It's like, nah, we're going to go a different way with this. And this company just goes bankrupt. And it's like,
and don't get me wrong.
All right, awesome.
Pump and dump, man. You got pumped and dump.
Don't get me wrong. I do enjoy picking stocks and researching, but it is not a majority of my holdings. It is not a large portion of what you would consider my personal balance sheet, right? I just like to have exposure to certain names, but a large majority of the securities I own are in mutual funds, and ETFs and that type of stuff. So to people watching, I'm not saying, go ahead and just put all your money in stocks.
And I think that's also why people 401ks like tend to do that.
Yeah.
I mean, yes, because they also don't look at it, they don't pull from it, but at the same time, there needs to be a diversified set of funds that you get to offer you. And there's no real individual stocks unless you're working for a company that wants you to invest in their individual, you get an employee stock ownership, like through your employee benefits. But at the same time, majority of it's going to be diversified. And I think that's why they tend to do better. That and on that end, people are less inclined to touch it when
that's a big factor.
Yeah, it's huge.
I think it's the two biggest things though. 401ks or retirement funds out, or being in 401ks outperform mostly everything is because 1, you don't touch it, 2, you don't look at it, and 3, the dividends that just reinvest over time. Right. That's a huge factor of just the dividends paying goes right back into the same thing over and over and over and over. So I think those are the 3 reasons why it outperforms.
I agree.
All right, guys, I want to kind of circle around. I want to overview a lot of what you just said, because we may have some new viewers, and you covered a lot. And basically where we're at right now, if you're just tuning in, we're talking about investing in the stock market. And if you can invest in the stock market right now, we've covered a couple options, but mainly the distinction between a individual stock in one company versus holding ETF, which is a collection of stocks of companies into one. Is that considered a security? Is that something that they can invest in specifically at like a stock? Is that how it works?
Absolutely. Yep. That's why it makes it. That's why Chris, I think, is such a big fan of them. They have their own ticker. They have their own name, and you just
zero trading fees on Fidelity and Charles Schwab.
Yep.
Mm-hmm. A little shout
Same
out
as a
there.
stock.
Little shout out to them. But you type in the ticker like you would type in the same ticker for, say, Amazon, and you just buy the shares of it, and you own,
Fractions
you own that share of ETF. So you own. You can think of it as fractions. You could think of it as like I was saying earlier. If that ETF you bought for $100 has a 10% holding of Apple, $10 or 10% of that $100 ETF is exposed to Apple, if that makes sense.
Got it. So let's run a little example here, because I'm sure people are watching and thinking that, okay, so what would I do? Because I know this is where I was at when I first decided, okay, I have some money I want to invest. If I'm just starting out with a lump sum, let's say $1,000, right?
Yep.
How would you invest that $1,000? I'm curious, Mike, and Chris, what would be your 2 strategies for that $1,000? Let's say you're in college, you're working part-time, and you're also probably going to graduate in like 2 years.
Can I default to this financial planner first?
Yeah, let me take it. The first thing I would figure out is, do you need this money? And how long do you have till you need actually to touch this $1,000? And if it's less than 3 to 6 months, even a year, I would say maybe make it very conservative. And even so, interest rates are kind of crummy, but like, you don't want to be investing now. You don't want to put $1,000 in that you're going to need in the next 6 months to a year and invest it, because God forbid, the big example is coronavirus, March 2020. Let's say you invest it, and then like you're going to start paying rent in as soon as you graduate college, and now the market's down 30-40%, and that $1,000 is more like $600, and now you have to sell that position at a loss. And I think that's what hurts people the most, is that they don't plan for, what are my short-term cash needs? And so once that's kind of settled and figured out, that I have enough money on the side to get through, the next year, and I don't need to touch this investments in case there is a pullback, and I don't want to sell at the absolute worst possible time, then you can start investing. And the way I would invest $1,000 is really ETFs. That's what I would do, because mutual funds tend to have a limit, and most mutual funds is a $2,500 minimum investment to invest in a mutual fund. Also a $25 trading fee. And yes, I love mutual funds for people that are investing long term, because I think having someone actively manage your funds makes sense. And I think having a good portion of that, taking advantage of real, investment managers looking over and trying to beat the benchmark over time. A lot of people disagree with this comment, because if you look at the last 10 years, ETFs have been doing incredible. But I think in areas where there's a lot of volatility, such as, emerging markets, and, I wouldn't actually do it in the bond market, because I don't think paying an expense ratio for a yield that's kind of crummy makes
basically not there.
Exactly. It's going to eat into your yield, and I don't really necessarily think that's a good idea. But I think taking $1,000 and spreading it around ETFs, and probably depending on your age group, your age limit, and how long you want to invest, I would tend to be more equities, and probably spread it around. Large cap growth tends to be a lot of technology companies that don't pay dividends. They're reinvesting in themselves, such as the Amazons, the Teslas, the Facebooks. They don't need to pay a dividend, because they're taking all their earnings and they're reinvesting in themselves. And you can tell from the last 10 years that they've appreciated, tenfold on what they've been doing. Value companies tend to hold a lot of cash on hand, and they tend to be a little bit more brick and mortar, and more they incentivize people by paying a dividend. And there's a lot of people out there that really look like, hey, I want to get a nice dividend for my investments, and that's how I want to save and grow my portfolio. But if you really looked over at the last 10 years, these growth companies that are not, instead of keeping a lot of cash on hand and investing in themselves, have just been completely outperforming value. And the way tech industry is kind of going up, this is Rose Wealth Advisors does not stand by. I don't know the disclaimer, but I totally.
Let me get it in there for you. Let me plug that for you real quick.
Believer.
Just so you, let me plug this real quick.
Don't listen to what he's saying.
This message,
but listen to what he's saying.
This message is not brought to you by Rose Wealth Advisors.
Even though the guy who
I'm a big
runs
believer
the joint
in Rose
is
stocks.
saying it.
I think this is the tip of the iceberg in the tech boom, and that's kind of my thought process there. But
how do you believe that this is at? Because I feel like we're on the up and up. No,
on growth.
No, he's saying technology. He's saying it's just starting.
Mm-hmm.
It's been beating value for the last 5-10 years. And I think coronavirus has sped up the technology boom. And honestly, I think
value had a nice little run. Or the
disclaimer: Mike loves value stocks.
No, I mean, yes.
So can you guys give examples? You guys need to give some examples of value versus growth and high cap. You're too high level right now, guys. I need you to bring it back down to like.
We're too much in the weeds. We're Chris. We're too
into the thick of it.
You're right.
Into the thick of it.
And also, for what it's worth, I think a portfolio should have growth and value and dividend paying stocks and everything.
I totally agree with that.
Because if you're just all in growth and tech hits a little speed bump, and because tech and growth are so volatile going up, they're going to be volatile going down too. So you don't want to be the one who sees your whole portfolio down 30% and you're like, what the hell just happened? So if you are balanced, you are going to see that certain you're like, oh, this company is down 30%. My portfolio is only down. I mean, 30% is crazy, but let's say the company is down like 7%, right? You see your portfolio is down 3. Maybe you won't freak out and sell everything.
Yeah. So we're okay. Back to the original question. What are you guys doing with this $1,000?
So
what are your top securities? Where do you put your money? You're like $1,000.
I'm not doing that.
Yeah.
That's him.
Like, all right, give it to me, Rick, because you know what? There's someone out there right now with $1,000.
You need to read my disclaimer, Will.
Okay, this is not. I already did that. This is not.
All right. So what I would do is, I mean, because you really can't buy.
This is not financial advice.
Funds. You can't buy mutual funds with less than $2,500. It's going to be
your hypothetical is you're too broke to
buy
the mutual.
That's not true.
I'm just teasing.
ETFs. Okay. I like it depends on your age, your investment horizon, and how aggressive you want to be, and and your cash needs for the short term. But realistically, I would take $1,000 and I would spread it over different sectors in over ETFs, because the sectors that they're really going to be your large cap S&P 500 is going to be a blend of large cap and growth. I'm sorry, it's going to be a blend of the growth and value. There's going to be large cap growth positions. There's going to be large cap value positions that I would have a mixture of all those. And that's going to be all your domestic equities. But I also think it's important to diversify. God forbid, I don't know, absolute crazy scenario. US goes to war with Canada and now you don't have any exposure to Europe and all your domestic equities kind of tank. So having exposure to Europe and developed countries, you can have an ETF there. That just means that companies are going to be headquartered in Europe, and you're going to have exposure there.
Russell.
Yes. So that's gonna be like your IXUS, which is like an iShares, ex-US companies, and emerging markets is going to be companies that are headquartered in Taiwan, China. It's going to be a heavy portion of China. It's going
Brazil.
to be a good amount of Brazil and India. And I think it's important to have exposure there. It's kind of been lagging over the last couple of years, but I mean, people are really, really big on China on the rebound right now. And Taiwan just,
I would be careful. China would be careful.
I would absolutely be careful.
I would be very careful. Not to cut you off, but it's to Chris's point, spread it around. If in this hypothetical scenario, you have 6 months to a year's amount of cash on the sidelines, that you're not going to feel like you have to sell your stocks if there's a 10%, 20% downturn. Spread it around. Because we forget that the US market we live here, right? We think in our everyday lives, we don't stop to think sometimes that there's companies in India and Taiwan and Brazil that we've never heard of because they don't sell their products to us. We don't see them on the streets. We don't see these things, but there's a whole world out there that has great companies. So that's a way for you to get the exposure to those other countries. And like Chris's crazy scenario where the US has a war with Canada, while US and Canada are duking it out and having a crazy war, other countries might be still just focusing on being good companies and producing goods and services, and they'll probably do better over that time.
I agree. And then there's other diversifiers as well, like people like kind of investing in real assets that aren't necessarily pegged to equities or fixed income. You can do an ETF that's going to focus on real estate. You can do an ETF that's going to focus on commodities, which will buy, you can check out the underlying holdings and there'll be a portion to gold, a portion to silver, a portion to oil. And, you can also look at investing in infrastructure and different things like in different areas like that to kind of, people look at it as an inflationary hedge. real estate's always been an inflationary hedge. So you can kind of
Mm-hmm.
diversify and invest in real estate through an ETF too. It doesn't necessarily need to be, buying a home or doing this. You can literally just put, $100 into like a Vanguard real estate in ETF, and now you have exposure to the real estate market. And it's actually probably been the biggest growing sector of 2021. So I think it's something to kind of diversify and look at different sectors through ETFs and build a portfolio. I would say check out for people just starting out. I like Ray Dalio's Lazy Portfolios. It's super super easy to kind of look through, and I think
Big
I
fan
think
of that. You're a big fan.
I'm a huge fan for people starting out because it's literally going to show you the returns of these ETFs and what you're kind of feeling. And hey, maybe this portfolio has a high allocation to gold, and I like, I see, doomsday coming, and I think gold's going to be really valuable. And I think there's people like
All the crazy gold bugs out there.
exactly. So
Yeah, I'm a silver guy. I got my
Big silver guy.
big silver guy and copper.
big, I remember your silver chains.
Remember those diamond rings?
Things. Yeah, no, but I think it's easy to create a diversified portfolio, and there's a lot of things out there that can help you do it. So I would definitely encourage you to kind of do your own research, look into ETFs, look into mutual funds, look into stocks, and build your own portfolio, and just kind of and make sure it's diversified, and that you're touching different sectors. And you're not doubling up on exposure by, hey, maybe I have a huge portion in Tesla, but I'm also buying this mutual fund that has a 15% allocation to Tesla, and that when you look at that, like, hey, that's no good. Like, you don't want to double up your exposure there. So I think just do your homework, and it's not hard. It should be kind of fun. I think it's fun. I don't know if it's your money and you're really saving. I mean, people get really into it. As soon as you start losing money, people get really, really into it. So I think it's fun to start playing now as you're young, you're in high school, you're in college. Really kind of tap into it and get started now.
So that was a great overview of the ETFs, and we know what stocks are. You mentioned mutual funds. I have a question, just as far as the person managing that mutual fund. How do you know that you trust them? Like, that's like you're putting a lot of money in now a person's hand versus putting it into something that's like arguably time tested, like an ETF or like something that tracks like the S&P 500.
You can go on Morningstar, you can see their track records, you can see how long they've been on the fund, how long they've been running it. You can see their performance against other mutual funds in their space, and you can see how and Morningstar will actually rank it like 1 to 100 on in 2021 this was the number one. In 2020 this was like a number 95. And I think you'll start to notice that as you see the number ones, it tends to be the ones that have a very concentrated position that are super aggressive. So I'd be very careful just to pick number ones, and really kind of do your homework as far as the underlying holdings of these mutual funds. And yeah, so that's kind of what I would look at first.
Yeah, and past performance doesn't always mean future performance, but it's an indication to show. It's just something to go off of. And again, you can always look at the holdings. You can always see those things. So yeah,
looking up someone's stats. It's like
kinda, yeah.
It's
it's like basing it off. It's like, all right, like with fantasy, not with like fantasy football, because that's just gambling. But like if you're looking and you're seeing a guy throws 40 touchdowns a year, kind of a good bet, right? It's kind of a good. You'll feel good about what you're doing.
Like, I'm gonna take Pablo Sanchez over.
He was
Mikey.
the best.
Like, I'm not gonna not pick Pablo first round. It's just
but you also got to check out that expense ratio.
Very true. Pablo's probably pricey.
Sanchez is managing
Pablo's probably really expensive.
He's gonna be charging like 3%
because he's the best.
And what does that look like for my return though? So, let's say he goes off and let's say he's MVP, you know, is
So
that,
you're saying, let's say the ETF returns 20%
yeah.
over the year.
Mm-hmm.
I don't really look at mutual funds as much as Chris does, but um, is it a quarterly fee? Is it an annual fee? Does it depend on the fund?
More money, the more the fee.
It's
That is that the case with mutual funds? I thought that was only hedge funds.
I'm actually not sure. I think it's
I thought hedge funds only
could be
really.
monthly.
I thought no, but I'm saying he's talking about performance fees. I
Oh
thought
no,
that's
there's
only a
no
hedge fund
performance
thing.
fees. It's really just gonna be their expense ratio is what you're gonna be paying.
I really had no idea, because I just know that when I was young, my father had my savings and my money in mutual funds. And for some reason, like I was just like, take my money out of the stock market. Cause like, the idea of even him managing my money at up to a certain point, it might have been like 18, 17. I was just like, I have no idea about anything in the stock market. I don't know anything about money. I just want to take my money out because I don't know. I don't, like it felt like gambling for me because I just didn't know anything about it.
Right.
So the, I think that's why the education is so important. Like that thing that everything you guys are talking about and educating, especially young people but anyone in general on the difference and what the expectations are when you're, investing in mutual fund and the fees associated with that versus, just investing in on your own, and figuring it out as you go. Like there's definitely a trade-off too, I'm sure, in certain cases too. If you have it, if you have the money, if you want to not worry and let someone do the thinking for you, the mutual fund seems like, you know, the
It does.
most logical thing.
Don't get me wrong, there's mutual funds out there with very high fees that are having awful years, and you look at it and you're like, why am I paying? I have to cover 2.5% to actually make a return on this investment, and it's down like 5%. So it's like you see stuff like that, and I mean, it's your advisor's responsibility to either say like, oh, this is just, we still believe in this fund, or, we're looking at it and being like, this is not worth the expense ratio that we're paying and getting out and swapping out. So
What is a good expense ratio then? Like what's a number to look out for?
mutual fund would be like 1%. An ETF would be like 0.09%, maybe less.
So anything over 1% is a red flag.
No, I mean yeah, it depends. I mean, it depends. So you could look at the performance, and it could be like Pablo Sanchez absolutely killing it every year, and you're paying two
Yeah, I mean,
percent on that.
if you're returning 30%, do you really
Yeah,
care about 2%, right? So don't be, foolish and just see 2% and be like, I'm not doing that. If they're seeing the past 5 years, it's compounding annually at 20%, that's something that you want to be a part of. But yeah, I think, yeah.
No, I was gonna say, can you just like explain that? I guess what is the expense ratio? Because maybe maybe I'm not even clear on what that actually means.
So, and Chris can step in and correct me if I'm wrong, but think of it as like Chris was saying, mutual fund, right? There's an actual mutual fund manager, right? That is overseeing all the investments in this mutual fund. He probably has a team under him, right? He probably has a team of research analysts. He probably has an operations team. He probably has, all these things to make the mutual fund work. They have to pay people, so it's just kind of like a cost of doing business, right? If you don't want to pay that fee, and Chris, you want to step in?
yeah, and it comes up to, how much money am I putting in this mutual fund, and how much money am I putting in my ETF, and they're taking a percentage of that for the year, and that's what they're going to be charging.
So yeah, basically it's just in the world of finance, it is, you always want to help people, you want to make people money, you want to do right by your clients, but at the end of the day, you're making money too, right? So these mutual funds are still a business at the end of the day. So they got to pay the bills and pay their employees. And so that's what the expense ratio really covers.
Okay, got it. So the expense ratio is essentially what is the fee, right? Like that's what you're
Yeah.
paying them.
Yeah.
But and it's
So
all
you're paying them to beat what a normal ETF would be.
Yes. You're paying them to. So if they're saying that their benchmark is, I don't know, the Russell 2000, right? Which is just a benchmark. It's just one of the benchmarks that they've said, this is what we have to beat.
Yeah, it's it's like all companies under a 2 billion market cap is going to be Russell 2000 and ETF. So it's going to be all small cap companies, and they're going to be focused in that area of all small cap companies trying to beat the Russell 2000.
Right. So it doesn't make right. So it doesn't make sense. So it has to make. It always makes sense, right? So basically, you're paying them to do better than the benchmark they say that they can beat. Because if you could just if the Russell 2000 is beating them every year by 5%, what the hell are you paying them for? Right? You might as well just put your money in the Russell 2000 and call it a day.
Yeah.
So that's basically what you're paying. Look, you're paying.
And that happens, and there's financial advisors that'll be like I've picked mutual funds, and all of a sudden it's performing the same, if not worse, than an ETF. Immediately I swapped out and go to that ETF, because it's like you're not getting the benefit of the additional fee, because
the manager stinks.
And he's not doesn't have it this year.
He doesn't have it this year. It's just not a good year. Not a good season.
Awesome. So mutual funds, the idea is to beat the benchmark versus ETFs, which kind of just track and historically kind of meet the benchmark, or they're setting the benchmark.
It depends. So like ETFs that, like, if you buy a ETF that is just supposed to kind of mirror the S&P 500, it's a way of you buying basically the S&P 500. If you're buying an ETF that is actively managed, I'm assuming there's a benchmark that they're trying to beat, right, Chris?
Yeah, and I think that's like a lot of the ARC ETFs. Those tend to be like a higher. I think it's usually like 0.75%.
ARC is still killing it, right? Like the ARC.
I don't know. I think they got whacked a little while ago. I stopped following them.
But just but their performance overall, I mean.
No, yeah, definitely, and they had
I mean, they show. So, I mean, they're just.
Can you give
they're just dominating. They're just, if you're looking at, they're higher, but the ETF was $38 a share December 25th, 2017, and it's at $122 now.
Oh, nice.
So
I thought they had a little pullback, but
they did. No, they peaked. Their all-time high, February 8th, 2021, was 154.50, and now they're at 122.64. So they did have a little bit of pullback, but it's still, the performance is still, outstanding.
Outstanding. So question with the mutual funds. I'm still on this. So if I were, if I'm going to invest in stocks, because I wanted to cover brokerage accounts too, but I'm just going to go ahead and just make the distinction. If I wanted to invest in ETFs, I could do that through Robinhood. If I wanted to invest through, for an individual stock, I could do that on Robinhood. Mutual funds. Where do you find these mutual funds? And what's the difference between, investing in a mutual fund or hiring someone like you, Chris, and you being that manager in a sense with my money?
Yeah. So the difference between you buying a mutual fund on your own and working with a financial advisor?
More so what, where do you first off, where do you start to invest in a mutual fund? Where do you go to invest in a mutual fund? And then,
first off, I look at and see where's the most volatility in what sector, and where are you getting the most value from having a mutual fund versus tracking an ETF. And most recently, it's been a lot of large cap growth positions and a large cap value positions, because having someone look at that and actually trying to pick the stocks that are, that are going to overperform rather than follow the benchmark is where I think you see the biggest discrepancy between ETFs and mutual funds. So that's really kind of where I build with mutual funds, but I also try to keep costs low for my clients by sprinkling in ETFs where I think it's not necessarily as important, and I don't think you get as much of a value. I don't think it's worth having active management in the fixed income space right now, because I don't think paying for somebody to eat into your yield is necessarily important. I think you can get, a steady rate of return, invest in spreading across different types of fixed income sectors and not having to pay a high expense ratio there. So the way that you work with a financial advisor is, and a financial advisor is going to have a list of their best mutual funds in every single different sector, their best ETFs in every single sector, and they're going to design a portfolio that makes sense for you. And like we were talking about before, there's a lot of clients that have ESG, their number one focus. So you customize the portfolio with the best ESG funds and best ETF, ESG mutual funds, and you design a customized portfolio for them. And the thing that I was working with an advisor is, one, they're going to make sure that your portfolio is always diversified on the risk tolerance that you decide. And when the risk tolerance I'm talking about is really, are you an aggressive investor, and are you going to be heavily equities and low fixed income? Do you want a lot of volatility in your portfolio? Are you comfortable with that? Or are you kind of leaning towards a more moderate, more safe portfolio that won't fluctuate in as much with the market, but also won't generate as much return? So what the advisor is going to do is going to build your custom portfolio. They're going to sprinkle in mutual funds and ETFs depending on where they think it makes sense, and they're going to monitor it, and they're going to make sure that that mutual fund that you're paying that extra percent is actually performing better than that benchmark. And if it isn't, they're going to swap it out for one that's better than that. So I think that's kind of how the financial advisors work. They're looking at different sectors. You're gonna need to talk to somebody like Mike if you want to pick individual stocks, and you want to really kind of work with a company like the one that Mike's at, and really kind of aim to get more individual securities in your portfolio. Working with a normal financial advisor, any Fidelity, any Schwab, any RIA, they're going to really build your portfolio with ETFs and mutual funds and try to create a custom portfolio for you that that's depends on your growth rate, depends on your upcoming cash needs and your goals, and that's really it.
So it's way more individual, way more personal, versus going and putting your money into a mutual fund. The funds are standard, or are they customized too? Is it like a fund? I'm sorry, I'm like hung up on this.
Yeah,
but
so
I'm really trying to understand the mutual fund.
So a mutual fund, it is it's not customizable because it is what the manager says is in the portfolio. So
got it. So you and I can have the same mutual fund.
Think of it as like, let's say I'm a mutual fund manager, right? And I'm trying to pitch you on my mutual fund, and I show you the S&P 500 over the past 5 years has performed, let's say it's, for argument's sake, a round number, it's performed 30%. But my mutual fund has performed at 50%. I'm basically saying to you, I've been better than the S&P 500, and that's why you should give me your money. It is not personalized in any way, shape, or form. You're basically buying a product from that mutual fund manager, and he's basically saying to you, you're paying me because I'm going to do better. and that's why you're paying me 2% or you're paying me 1%. And you are basically putting your trust in that mutual fund manager who is not going to know who you are. You know, whereas as someone like Chris, where he's a financial planner, he is going to have sit downs with you. You're going to express your goals. You're going to tell him what you're comfortable with, what you're not comfortable with, where you want to be in 3 years, where you want to be in 5 years, 10 years, it's, you know, down the road. Where a mutual fund, they're basically just trying to do the best for their shareholders in the mutual fund. And that's to outperform the benchmark. And, you know, that's like Chris is basically, he's just very, very individual, very one-on-one. And basically like, it's like an a la carte type of situation, right? Like you're telling him, he's going to ask you, do you like growth? And if you say he's going to advise you, like, I like growth. I think growth is really good. But you know, if you're someone who's 75 and is just giving your money to Chris now, I'm sure he's not going to put you in growth. You know, it's going to be very, or it's going to be oriented to the individual. Whereas a mutual fund is you're basically buying a product.
Yeah. You're figuring out their risk tolerance, you're figuring out the goals, you're figuring out their cash needs, what they plan on doing with their money, when do they plan on retiring, and kind of really painting a picture and then designing a portfolio that makes the most sense for them. I think there's other aspects that I think we can dive down to like a different episode as far as like investing in ETFs and mutual funds. And one of probably the coolest things I did at my last company was during the pandemic, we had a lot of people in ETFs and mutual funds. And then as soon as it dropped 30%, we were constantly tax loss harvesting, where you're swapping Vanguard S&P 500 for iShares S&P 500, essentially holding identical underlying holdings in each of them, but you're capturing a loss that you can offset gains with or taking your tax return. And we can get into that another time. But I think that was one of the cooler parts of you know, investing for and being a financial advisor and taking advantage of things that I think people don't have time to do in the day. They don't have time to look at their accounts and constantly making trades when there's giant market swings like we felt back in the Corona. But I think that's kind of a big benefit to working with a financial advisor.
Yeah, I'm gonna say, Mike, I think you first sold me on Chris's services when you were, you know, talking on his behalf, and now I'm just like, I'm really thinking, because I have, you know, geez, I wish that someone told me to sell Tesla when that thing was up, because I got in early enough and I stuck around too long. And I saw I was up, you know, really like over, I don't even know the percentage, but my money was certainly doubled.
Do you actually believe in Tesla? That's what I mean when I say, like,
I was definitely riding the wave for sure. And I'm an early I'm very amateur investor. And that's why I'm thinking, like, even, you know, having someone, you know, like Chris managing that portfolio that I have on, which is Robin is still using that, right? But having someone to move those around when, you know, they understand things better than I do.
Right. And it's just, that goes back to the whole, like, so back to what I was saying in the beginning was, if you really are into a stock or a company and you really believe in them, if it dips 25% and you really believe in it, you're not going to sell. You're going to buy. Right. But also don't be foolish and just buy because you think it's on sale for 25%. It might not be the case. So,
yeah. And I think it's important to work with somebody who actually knows your situation.
Right.
And there's ways around, you know, I have Tesla now, it's boomed, and I've owned it since, you know, the day it started. And there's ways around it to kind of to do tax planning and figuring out and get away the capital gains. Like, you can open up a donor advised account and you could literally, you know, not realize any capital gains and have that into the account, and it can sit there for any kind of charitable giving you do. There's qualified opportunity zones, which we can touch on in another episode, where you can literally take that gain and deferred into like a low income real estate investment. It's kind of one of those a tax advantage that's been used to encourage people to invest in low income areas, and there's huge benefits to doing that, where you can just defer capital gains. So I think working with a financial advisor who knows your situation is a shameful plug by myself with my situation, but
Shameless.
I think there's a huge benefit. Doesn't matter your income. There's advisors out there for everybody.
I'm sold. We'll talk after this.
Talk to an advisor who knows your situation, develop a relationship, and honestly, it's for the best, I think.
Do you guarantee a return? No, right?
No, absolutely not. You think I know what's going on? Like, I just created
you think I know what's going on with this thing?
I created a diversified portfolio. I invest for the long term. We have cash. We have enough cash needs on the side to cover, so you're not going to touch it for however long you need to.
Chris is in the game of mitigating risk.
I do know.
He loves making sure that you're okay.
I think it's an old school. It's literally an old school advisor thing where they're selling performance, and that's dead. That's literally, I think it's out the door. It's my personal opinion. I don't think if you have somebody telling you that they're going to constantly beat the market, I think you should run away. But that's just me. Maybe they can. I don't know. I've never invested with them, so don't take my word for it. There's also very, very, very talented investment advisors out there that maybe they can do it, but they're also, I don't think I got the money for them to even sniff at me. So I just create a diversified portfolio. Look at your taxes, look at your cash flow, look at your balance sheet, and look for opportunities to drive the most return, whether it's trying to hold certain assets in different accounts to mitigate your taxes, holding bonds in a deferred tax account where you would pay ordinary income, holding qualified dividends in a taxable account where that kicks off and you pay capital gains tax, and kind of looking at your situation and trying to maximize it while you're building a diversified portfolio for the long term. And that's how I work with my clients.
Awesome. And can you just let those new potential clients know where they can find you? Just because I think that I think it's a shameless plug. I think it's
shameless plug. Go to www.rosewealthadvisors.com. You can enter your information. I'll get back to you as soon as possible.
Any promo code?
Yeah, if you enter in HypeLite, you can save 15%.
Ooh, you said
he's like, just kidding. Full price.
Come on, man. All right, well, we'll get to that point at some point. I think that I think about it a lot too. It's a good peace of mind when you obviously do your research and you know what you're invested in, what you're holding, and but having someone else do it too, who you trust also, because I think that's a big thing for people who put their money into someone else's hands. It's like they want to trust you too. They want to, that's why as a kid, I was like, I didn't want my money in the stock market because I just didn't know. I didn't have trust. I didn't trust the process. So I definitely trust you. So I'm going to set that meeting up for you.
Man, I already told you, I got the 990 HypeLite foundation return.
Yeah, we got to get we're at the 990 end right now. It's a postcard. So it's really, it's just a matter of clicking. There's no real.
Just sending it in.
But yeah, so definitely covered a lot, guys. So many more. Do you have any last final words on getting started in investing?
Just do it
in the stock market. Just do it.
Just not even saying I'm not saying just do it in the sense of just blindly invest in a bunch of stuff, but it's so easy nowadays to open an account. E-Trade, Robinhood, TD Ameritrade, Fidelity, Schwab, wherever you go. Obviously do your research on like the platform and the interfaces. Some people have preferences as to what they value with charts and research and all that stuff. But I just wouldn't wait. Just any little bit you can invest and start is always better than nothing. So I would just, it's so easy nowadays. You don't need a ton of money to get started. You really don't need anything. You can open accounts with zero money in the account. So I would just say, just do it.
Great.
Awesome. Those are your final words, Chris?
Yeah.
It's good. Short and sweet.
Totally agree. I don't think it
good
takes
thing we got the episode real short and sweet. 30 minutes, guys.
right over.
One day we'll hit the goal.
I had a fantasy football draft. All my first 4 picks are garbage now.
Oh,
you're doing it right now?
I was supposed to.
Oh,
you auto drafted?
Team looks terrible.
Oh shit.
Next week you got to tell us what the lineup is so we can roast you.
Hopefully you got Pablo Sanchez in there somewhere.
Not good. Not good. Got a little distracted there towards the end. I don't know if you can tell.
A little bit, but it's all right. It's all right. It's dinner time. It's beyond dinner time. So I just want to thank everyone. Thank our 2 financial advisors. I'm sorry.
Not I.
Yes, not Michael, but thank Chris for your financial advice. Can we say that? You can officially say this is financial advice, right?
Yeah. Why do you need a disclaimer?
I don't need it.
I need it because I can get in trouble. You can't tell on yourself.
Yeah, but I also don't want to give recommendations.
That's fair.
Too late for that one.
Some of them will pull over.
All right, guys. So thanks everyone for tuning in. This is another episode of Money Talks, weekly talks about all things money and finance. You can find us moving forward at Monday night, 7 p.m. Eastern time. This is Will Esposito signing out from HypeLite. Peace.
See you.
Wait,
Later, guys. See you next week.